Japan has just implemented the most consequential monetary policy decision in 3 decades by raising interest rates for the first time since the 1990s. This seemingly modest policy adjustment has triggered what could become a $20 trillion global financial crisis. The decision breaks apart the massive yen carry trade system that has underpinned international capital flows for over 30 years. Global markets now face systematic liquidation pressures that could devastate portfolios within the next 90 days. Understanding the magnitude of this crisis requires examining how the yen carry trade actually functions. For decades, investors borrowed Japanese yen at near-zero interest rates to purchase higher-yielding assets worldwide. This strategy worked perfectly when Japanese rates remained artificially suppressed, while other economies offered positive returns. Borrowers could access virtually free capital while investing in assets generating substantial profits from interest rate differentials. The carry trade system evolved into the backbone of modern international finance. Hedge funds, investment banks, pension funds, and individual investors all utilized yen borrowing to leverage investments across global markets. Conservative estimates suggest over $20 trillion in capital flows depend on continued access to low-cost Japanese financing. This massive capital structure now faces complete unwinding as Japanese rate increases destroy the fundamental economics. The mathematical relationship underlying carry trades becomes unsustainable when funding costs exceed investment returns. When Japanese rates approached 0%, investors could borrow yen cheaply while earning 5, 6, or 7% returns in other markets. The spread between borrowing costs and investment returns provided consistent profits that encouraged massive position sizes and extensive leverage usage throughout the global financial system. However, Japanese rate increases immediately impact this calculation by raising borrowing costs while investment returns remain unchanged. A 2% Japanese rate increase transforms profitable carry trades into loss-generating positions overnight. Investors face immediate pressure to unwind positions before losses accelerate beyond manageable levels. This unwinding process requires selling investment assets and repurchasing Japanese yen to repay borrowings. The forced liquidation mechanics create systematic selling pressure across all asset classes simultaneously. Carry trade investors must sell bonds, stocks, real estate, commodities, and alternative investments to generate cash for yen repurchase and loan repayment. This selling occurs regardless of asset fundamentals or market conditions because mathematical necessity drives liquidation rather than investment merit considerations. The scale of required liquidations dwarfs normal market capacity to absorb selling pressure without dramatic price impacts. $20 trillion represents approximately 40% of total global stock market capitalization. Even partial unwinding of carry trade positions generates selling volumes that exceed normal trading activity by substantial margins. Markets cannot absorb this liquidation volume without significant price disruptions across all affected asset categories. The timeline for forced liquidations operates much faster than normal investment cycles because leverage amplifies losses and margin requirements force immediate action. When carry trade positions move against investors, they face margin calls requiring additional capital or position closure within days rather than weeks or months. This compressed timeline prevents orderly liquidation while forcing simultaneous selling that overwhelms market absorption capacity. Japanese institutional investors face particularly severe pressures because they hold enormous quantities of foreign assets purchased through yen carry trade financing. Japanese pension funds, insurance companies, and government investment funds collectively own several $trillion in foreign bonds and stocks. Rising Japanese rates make these foreign investments less attractive, while simultaneously increasing the cost of maintaining positions through yen borrowing. The Bank of Japan's decision reflects recognition that suppressed interest rates have created financial stability risks that require correction despite potential market disruption. Decades of zero interest rate policy encouraged excessive leverage and risk-taking throughout Japanese financial institutions while creating asset bubbles that threaten long-term economic stability. Normalizing interest rates addresses these structural problems but triggers short-term adjustment costs. International coordination among central banks becomes complicated when Japanese policy normalization conflicts with other nations' monetary policy objectives. The Federal Reserve, European Central Bank, and other major central banks must balance their domestic policy goals against potential disruption from Japanese carry trade unwinding. This coordination challenge could amplify market volatility if policy responses appear uncoordinated or inadequate. The currency market implications create additional complexity because yen carry trade unwinding requires massive yen purchases that could drive dramatic currency appreciation. Stronger yen makes Japanese exports less competitive while reducing the profitability of Japanese companies earning revenue in foreign currencies. These effects could offset the benefits of higher interest rates while creating new economic challenges for Japanese policymakers. Global bond markets face particular vulnerability because carry trade strategies often involve borrowing short-term yen to purchase longer-duration foreign bonds. This maturity mismatch creates interest rate risk that becomes dangerous when Japanese rates increase rapidly. Bond investors face both rising funding costs and potential capital losses if bond prices decline due to rising global interest rates or increased risk premiums. Equity markets experience selling pressure from multiple sources, including direct carry trade liquidations and indirect effects from credit tightening and reduced leverage availability. Growth stocks with high valuations become particularly vulnerable because they depend on continued access to cheap capital for business expansion and investor appetite. Value stocks may provide better defensive characteristics, but still face systematic selling pressure from forced liquidations. Real estate markets worldwide could experience significant disruption because property investments often utilize leverage that becomes expensive when Japanese funding costs increase. Commercial real estate faces particular risks due to high leverage ratios and dependence on refinancing availability. Residential markets in countries with significant Japanese investment could see reduced foreign buying pressure while domestic buyers face higher borrowing costs. Commodity markets reflect complex dynamics because industrial commodities could benefit from reduced speculative positioning while precious metals might gain safe haven demand. However, forced liquidations could create temporary selling pressure across all commodity categories before fundamental supply-demand factors reassert influence. Energy commodities face particular uncertainty due to their sensitivity to global economic growth prospects. Cryptocurrency markets show extreme vulnerability to carry trade unwinding because digital assets attracted substantial leveraged investment from carry trade profits. The combination of high volatility and extensive leverage usage creates conditions where forced liquidations could generate dramatic price declines. Bitcoin and other major cryptocurrencies could face selling pressure from both direct carry trade unwinding and broader risk-off sentiment. The private equity and hedge fund industries face dual pressures from both portfolio liquidations and reduced access to leverage for new investments. Many alternative investment strategies depend on accessing cheap financing to enhance returns through leverage application. Higher Japanese borrowing costs reduce the attractiveness of leveraged strategies while potentially forcing existing position liquidations. Banking sector implications extend beyond direct carry trade exposure to encompass broader credit market disruption and reduced lending activity. Banks that provided financing for carry trade strategies face potential loan losses while also experiencing reduced demand for new lending services. Interest rate increases could benefit banking profitability long-term, but create short-term adjustment challenges. Insurance companies and pension funds face complex adjustments because their asset-liability matching strategies assumed continued access to low-cost financing for duration extension and yield enhancement. These institutional investors may need to restructure portfolios significantly while facing potential losses on existing positions that utilized yen carry trade financing strategies. The technology sector could experience disproportionate impact because many technology companies and investors utilized carry trade financing to fund expansion and investment activities. Higher borrowing costs reduce the attractiveness of growth investments while potentially forcing selling of technology positions to raise capital for carry trade unwinding. Emerging market economies face particular risks because they attracted substantial carry trade capital seeking higher yields than available in developed markets. Capital outflows from emerging markets could create currency pressures and economic instability in countries that became dependent on foreign investment inflows. This creates spillover effects that extend beyond direct carry trade participants. International trade relationships experience disruption when currency volatility and capital flow changes affect trade financing and hedging costs. Companies engaged in international commerce face increased costs and complexity for managing foreign exchange exposure, while potentially experiencing reduced access to trade financing through traditional banking channels. The derivatives market plays a crucial role in both amplifying and potentially mitigating carry trade unwinding effects. Currency derivatives, interest rate swaps, and credit default swaps all experience increased trading volumes and volatility. These instruments can provide hedging opportunities, but also create additional risks if counterparties face financial stress from carry trade losses. Regulatory responses could include emergency measures designed to slow the pace of carry trade unwinding while providing stability to affected markets. However, regulatory intervention carries risks of creating moral hazard while potentially delaying necessary market adjustments. The effectiveness of regulatory responses depends on international coordination and market participant cooperation. Market structure considerations include the role of algorithmic trading and high-frequency trading systems that could amplify volatility during forced liquidation periods. Trading algorithms designed for normal market conditions may malfunction when volumes and price movements exceed programmed parameters. This technological factor could accelerate price movements beyond what fundamental factors alone would generate. Historical precedents provide limited guidance because the scale of current carry trade exposure exceeds previous episodes where similar unwinding occurred. The 1998 Asian financial crisis and 2008 global financial crisis both involved carry trade disruption, but at much smaller scales than current conditions suggest. These historical examples show that carry trade unwinding can create systemic risks that extend far beyond direct participants. Risk management strategies for individual investors include reducing leverage exposure, maintaining adequate cash reserves, and diversifying across asset classes that might respond differently to carry trade unwinding. However, the systematic nature of potential liquidations means that normal diversification strategies may provide limited protection when all asset classes face selling pressure simultaneously. Professional investment management faces challenges in providing portfolio protection when traditional hedging strategies may prove ineffective during systematic liquidation events. Hedge funds and asset managers must balance client protection against potential opportunities that could emerge from dislocated markets during forced selling periods. The psychological aspects of forced liquidations create momentum effects that can extend price movements beyond what mathematical necessity alone would generate. Fear-driven selling from investors not directly involved in carry trades can amplify the effects of systematic liquidations while creating feedback loops that perpetuate market stress conditions. Central bank policy responses become crucial for determining whether carry trade unwinding creates temporary market disruption or evolves into systematic financial crisis. Emergency liquidity provision, coordinated interest rate policies, and direct market intervention all represent potential tools for managing the adjustment process. The geopolitical implications include potential tensions between Japan and other nations if Japanese policy decisions create economic hardship elsewhere. International economic cooperation becomes more difficult when domestic policy priorities conflict with global stability considerations. These tensions could affect trade relationships and diplomatic cooperation on other issues. Long-term structural changes in global capital markets could result from carry trade system breakdown, even if immediate crisis effects are managed successfully. Financial institutions may permanently reduce leverage usage while investors become more cautious about currency-based investment strategies. These behavioral changes could alter global capital allocation patterns permanently. The timeline pressure creates urgency for both policymakers and market participants to respond effectively before systematic risks become unmanageable. The 90-day timeframe reflects estimates of how long highly leveraged positions can withstand adverse price movements before forced liquidation becomes unavoidable, regardless of longer-term investment merit. Economic research on carry trade dynamics suggests that unwinding episodes tend to be both rapid and severe because leverage amplifies losses while forcing simultaneous action across numerous market participants. Academic studies of previous episodes show that carry trade unwinding can create contagion effects that spread across seemingly unrelated markets and geographic regions. The interconnected nature of modern financial markets means that carry trade unwinding affects institutions and investors who may not have direct exposure to Japanese yen borrowing. Credit markets, equity markets, and commodity markets all face indirect effects through reduced liquidity and increased volatility that affects all market participants regardless of their specific strategies. Emergency planning for both institutional and individual investors should include scenario analysis for rapid market declines across multiple asset classes simultaneously. Traditional portfolio protection strategies may prove inadequate when systematic liquidations create conditions that exceed normal risk management assumptions about correlation relationships and liquidity availability. This analysis examines the systematic risks created by Japanese monetary policy changes and their potential impact on global financial markets. The scale and interconnected nature of yen carry trade positions create conditions where orderly unwinding may prove difficult regardless of policy responses or market interventions. Understanding these dynamics provides context for evaluating current portfolio risks, while recognizing the inherent uncertainty in predicting exact timing and magnitude of potential market disruptions. The $20 trillion estimate reflects conservative calculations of total carry trade exposure based on available data about international capital flows and leverage usage. Actual exposure could prove higher if hidden leverage or off-balance sheet positions exceed current estimates. This uncertainty adds additional risk to an already precarious situation that requires careful monitoring and preparation for various potential outcomes.